Disclaimer.
AG here, and you know what's funny? When your Asian parents have been stacking silver for decades and Wall Street calls them paranoid, then Bank of America drops a $309 price target, and suddenly everyone wants to know what your family knew all along. Today, we're breaking down why the smartest money on earth just admitted they were wrong about silver, and why they're still underestimating what's coming. What happens when one of the world's largest banks spends decades dismissing an asset as a relic, then suddenly projects it could hit $309? Bank of America just did exactly that with silver, and the timing couldn't be more suspicious. For years, BofA maintained the party line that precious metals were yesterday's investment, relics of a bygone era when people didn't trust digital systems. Their analysts consistently steered clients toward equities, bonds, the traditional portfolio mix. Then, in late 2025, something shifted. They released a forecast that stopped traders in their tracks. Silver could reach $135 per ounce as a conservative target. Under certain conditions, they said, it could touch $309. Here's what should grab your attention. BofA's average target for 2026 sits at $65. Not 40, not 50, 65. Think about what that means. One of Wall Street's major institutions built models, ran scenarios, consulted with commodity experts, and concluded silver would average $65 this year. The market called their bluff in weeks. Either their analysts drastically underestimated the forces at play, or something fundamental changed in the physical metal markets that even sophisticated models couldn't capture. Let me walk you through what changed. And trust me, this isn't about some abstract commodity theory. This affects your portfolio, your purchasing power, and possibly the industrial supply chains that keep our economy running. On January 1st, 2026, just days ago, China implemented something that blindsided most Western investors. They introduced export licensing requirements for silver. Not tariffs, not quotas, licensing. The Chinese government reclassified silver from an ordinary commodity into a strategic resource, putting it in the same category as rare earth elements. You know, the materials that go into every smartphone, every electric vehicle battery, every advanced weapon system our military depends on. Here's the mechanism they chose. Only 44 government-approved companies can now export silver from China over the next 2 years. 44. Out of thousands of potential exporters, China produced and processed massive amounts of silver in recent decades. According to industry data, they exported 4,600 tons in just the first 11 months of 2025. That's roughly 148 million ounces flowing into global markets. Now imagine that spigot getting restricted to a handful of state-approved channels. You might be thinking this sounds like typical government bureaucracy, maybe some protectionist trade policy. But China doesn't make moves like this casually. When they restricted rare earth exports in 2010, global prices quintupled within months. Industrial buyers in the United States, Europe, and Japan scrambled to secure alternative supplies. Some companies couldn't get the materials they needed at any price. Our government eventually had to restart domestic rare earth production after decades of depending on Chinese supply. The silver situation carries even more weight because of what happened simultaneously. China is simultaneously a net importer of silver overall. Read that again. They're restricting exports of a metal they actually need to import to meet their own industrial demand. This isn't about hoarding a surplus. This is about controlling a strategic resource during a period of heightened geopolitical tension. Now let's talk about what's happening in the actual physical markets, because this is where the story gets really interesting. If you tried to buy physical silver in Tokyo right now, you'd find dealers quoting prices around $130 per ounce. Not 80, not 90, 130. That's an 80% premium over the spot price displayed on financial terminals in New York and London. In the United Arab Emirates, similar disconnects emerged. Dealers in Dubai reported selling silver coins and bars at prices that would make Western buyers' eyes water. Shanghai premiums hit $8 over spot, a level typically seen only during panic buying. This isn't some temporary blip. Major online dealers in the United States reported record demand throughout late 2025 and into early 2026. Check their websites yourself. You'll see out-of-stock notices on popular products, shipping delays extending to weeks, premiums that keep climbing. The American Silver Eagle, our country's official silver bullion coin, sells for $90 to $95 when spot silver quotes at $80. That's a 15 to nearly 20% premium on a government-minted coin that used to trade within a few dollars of spot price. Have you noticed this disconnect in other markets recently? When paper price says one thing, but physical availability and real transaction prices tell a completely different story. It happened with lumber during the pandemic. It happened with used cars. It's happening now with silver. But the implications run deeper because silver isn't just a consumer good. Think about what silver actually does in our economy. It's not just jewelry and coins. Solar panels require silver paste for conductivity. Every electric vehicle contains about an ounce of silver in various components. Medical devices use silver for its antibacterial properties. 5G infrastructure demands silver for high-frequency circuits. Missiles and defense electronics depend on silver's unique electrical properties. This is infrastructure, national security, and the energy transition all wrapped into one metal. And here's the concerning part. About 70% of global silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. Unlike gold, where mines specifically target gold deposits and can ramp up production when prices rise, silver supply is tied to the economics of entirely different industries. When copper demand drives mining operations, silver is what geologists call an incidental output. This makes silver supply remarkably inelastic. Prices can double or triple, but if copper miners aren't expanding operations for copper-related reasons, silver production barely budges. The cost structure tells its own story. According to mining industry data, the all-in sustaining cost to produce silver now approaches $1,600 per ounce when you properly account for capital expenditures, exploration, and full operational expenses. Yet spot prices sat below $80 for months. How does that math work long term? It doesn't. Miners either need higher prices or they shut down operations. And remember, most silver comes as a byproduct, so shutting down a silver-producing mine actually means shutting down a copper or zinc operation. The economics get complicated fast. You're watching a setup that experienced commodity traders recognize. Restricted supply from a major exporter, physical premiums signaling genuine shortage, industrial demand that's non-discretionary, inelastic production response, and major financial institutions suddenly flipping their forecasts to levels that seemed unthinkable just months ago. Bank of America didn't pick those target numbers randomly. The $135 conservative target uses a gold to silver ratio of 32 to 1, which matched the ratio we saw in 2011 during the last precious metal surge. Their $309 target applies the 14 to 1 ratio from 1980, when silver briefly became the most sought-after commodity on Earth during the Hunt brothers situation and the Iranian Revolution. Both of those historical moments involved crisis conditions, monetary instability, geopolitical shocks, industrial buyers competing with investors for limited physical supply. Does any of that sound familiar as we enter 2026? The Chinese export restrictions took effect on January 1st. It's now early January. The supply impact hasn't fully hit Western markets yet because there's still silver in transit, still inventory in dealer vaults, still some flexibility in the system. But watch what happens over the next 60 to 90 days as that buffer gets consumed and industrial buyers realize the easy Chinese supply is gone. BofA's analysts saw this coming. That's why they published a forecast that seemed absurdly bullish by historical standards. What they might not have fully anticipated is how quickly the physical markets would decouple from paper prices, how aggressively Chinese policy would tighten, and how much pent-up demand exists from both industrial users and investors who've watched gold run to record highs while silver lagged behind. You're not looking at a prediction anymore. You're watching the early stages of a supply crunch that could reshape the precious metals market for years. And we're just getting started. Let's talk about the numbers that Bank of America saw when they built their models. Because this isn't speculation anymore. This is math. Global silver mine production is expected to decline by 2% in 2026, according to industry forecasts. Not stay flat, not grow modestly, actually decline. Now think about what's happening on the demand side during this same period. Solar panel manufacturers are consuming silver at an accelerating rate because every photovoltaic cell needs silver paste to conduct electricity efficiently. The Silver Institute projects that if current trends continue, solar demand alone could consume 100% of global silver supply by 2050. Not 50%, not 75%, all of it. You might be thinking that's decades away, so why worry now? Here's why. Markets don't wait for shortages to materialize before pricing them in. Smart money positions ahead of the crisis. And when you've got production falling while solar installation rates are hitting record highs globally, the trajectory becomes pretty clear pretty fast. Remember what I mentioned earlier about 70% of silver coming as a byproduct? This is where that fact becomes crucial. When copper prices dropped in 2023, several major mining operations scaled back production or delayed expansion projects. Those decisions affected silver output, but silver prices at the time didn't justify restarting those operations for silver alone. The economic incentive wasn't there. Miners look at copper markets, lead markets, zinc markets to make production decisions. Silver is just along for the ride. Here's the problem with that model right now. According to mining industry analysis, the all-in sustaining cost to produce silver has climbed to roughly $1,600 per ounce when you properly account for everything. Capital expenditures to open new mines or expand existing ones, Exploration costs to find new deposits, labor, energy, environmental compliance, transportation, the real cost of getting silver out of the ground and into a refined bar. Yet spot prices sat in the $20 to $30 range for years. Even at $80 today, miners are barely making acceptable returns on silver as a primary product. This creates a perverse situation where demand grows, supply shrinks, but bringing new production online remains economically questionable unless prices surge dramatically higher. And we're talking about an industry that needs prices well above current levels just to justify the investment required to meet growing demand. Now let's examine the paper versus physical breakdown, because this is where you can see the system starting to crack in real time. American Silver Eagles, minted by the United States Mint, sell for $90 to $95 at major dealers right now. The spot price on COMEX futures, $80. That's a 15 to 19% premium on a government-issued coin that traditionally trades within 3 to 5% of spot. Walk into any coin shop in America and try to buy silver at spot price. They'll laugh. Not because they're greedy, but because they can't replace their inventory at spot. Wholesale markets are already pricing in scarcity that paper markets haven't fully acknowledged. Across the Pacific, and the disconnect becomes even more extreme. Japanese dealers quoted silver at $130 in early January. That's an 80% premium over COMEX spot prices. In the United Arab Emirates, similar premiums emerged for physical delivery. Shanghai premiums hit $8 above London spot, a level that signals genuine tightness in Asian physical markets. These aren't small discrepancies that you can explain away with shipping costs or temporary demand spikes. This is systematic repricing happening in physical markets, while futures exchanges maintain the illusion of ample supply. Here's what should really make you pay attention. Over New Year's weekend, when most people were celebrating and markets were closed, COMEX raised margin requirements for silver futures twice in 48 hours. Margin requirements are the collateral traders must post to hold futures positions. Exchanges typically raise margins when they perceive increased volatility or risk in the market. Raising them twice in 2 days during a holiday weekend when nobody's watching? That's not routine risk management. That's stress showing through the system. Think about the timing. Chinese export restrictions take effect January 1st. Physical premiums are exploding globally, and the largest futures exchange for silver trading in the Western Hemisphere quietly makes it more expensive to hold short positions right when Chinese supply is getting cut off. Someone at COMEX saw what's coming and moved to protect the exchange from a potential short squeeze. But there's more happening behind the scenes that most people aren't connecting yet. On December 26th, the Federal Reserve delivered a $17 billion emergency cash injection to an unnamed bank. Not through normal repo operations, not through standard liquidity facilities. An emergency injection to a specific institution during the week between Christmas and New Year's when everyone's attention was elsewhere. The Fed doesn't typically disclose which banks receive emergency funding, but $17 billion isn't pocket change. That's serious liquidity stress at a major financial institution. Could this be related to silver? Possibly. Several banks hold significant short positions in precious metals, futures markets as part of their commodity trading operations. If physical delivery obligations are coming due and physical metal is increasingly difficult to source at paper prices, a bank could face a severe liquidity crunch trying to cover those positions. I'm not saying this injection was definitely silver-related, but the timing raises questions worth asking. Meanwhile, China's money supply tells its own story. M2 growth hit 8.2% year over year in late 2025, according to People's Bank of China data. That's liquidity flooding into the Chinese economy at levels not seen since their stimulus measures during the pandemic. Where does that money go? Some into real estate, some into stocks, but increasingly into hard assets that hold value during currency expansion. Silver qualifies perfectly as an industrial metal with monetary characteristics. You're watching synchronized policy moves across the world's two largest economies. China restricts silver exports while expanding domestic liquidity. The United States injects emergency cash into the banking system, while our federal government adds silver to the critical minerals list in November 2025. That critical minerals designation puts silver in the same strategic category as lithium, cobalt, and rare earths, materials our government considers essential for national security and economic competitiveness. Have you noticed how these pieces fit together? Industrial demand rising, physical premiums surging, supply getting restricted, monetary authorities taking defensive positions, exchange rules changing to protect against volatility. All of this converging in the span of weeks, not years. Let's ground this in something you can verify yourself. Go to any major online bullion dealer's website right now. Look at their inventory levels for popular products. Check the premiums they're charging above spot price. Notice the delivery times listed. Compare those numbers to what you saw 6 months ago, a year ago. The physical market is already behaving as if silver is scarce, even though paper markets still quote prices that suggest plenty of supply. This is what Bank of America's analysts saw when they ran their projections: a fundamental supply-demand imbalance that paper markets haven't fully priced in yet, production declining while industrial consumption accelerates, physical premiums indicating real shortage conditions, geopolitical moves restricting supply from major exporters, and all of this happening while global monetary conditions remain loose, creating the perfect environment for hard assets to revalue sharply higher. Their conservative target of $135 uses the gold to silver ratio of 32 to 1 that prevailed in 2011. Back then, gold hit $1,900 while silver touched $48. If gold sits around $4,300 today and you apply that same ratio, you get $134 silver. That's their baseline scenario, assuming normal market dynamics. Their aggressive target of $309 applies the 14 to 1 ratio from 1980. That year was unique. The Hunt brothers attempted to corner the silver market while the Iranian Revolution disrupted oil supplies and inflation raged out of control. Silver briefly became the most sought-after asset on Earth, hitting $50 when gold traded around $800. Apply that 14 to 1 ratio to today as gold price and you land at $307. BofA rounded to $309. Now ask yourself this question. Are current conditions more similar to 2011, or are we heading towards something more extreme? You've got geopolitical tensions escalating globally, monetary expansion continuing despite inflation concerns, supply chains getting weaponized through export restrictions, industrial demand for silver accelerating due to energy transition mandates that governments aren't backing away from, and physical markets already showing stress before the full impact of Chinese restrictions hits. Bank of America published their forecast based on historical precedents. What they're watching now is whether 2026 becomes one of those precedent-setting years that future analysts study. The setup is there, the catalysts are in motion, and the physical evidence suggests the market is already moving faster than their models anticipated. We're not talking about distant possibilities anymore. We're watching measurable supply destruction, documented policy changes, and quantifiable price disconnects between paper and physical markets. The proof isn't in some obscure correlation or academic theory. It's in the premiums you pay when you try to take delivery, the margins exchanges are requiring, and the strategic positioning of institutions that have access to information most investors never see. This is what the deep dive reveals. A systematic repricing that started in physical markets and is working its way through the financial system, whether paper prices acknowledge it or not. Now let's do the math that matters. Because once you see these numbers, the conclusion becomes unavoidable. China exported 4,600 tons of silver in the first 11 months of 2025. That translates to roughly 148 million ounces flowing into global markets from Chinese refiners and exporters. Now that supply gets channeled through 44 government-approved companies starting January 1st, 2026, not 400 companies, not even 100, 44. Here's what makes this even more significant. China is simultaneously a net importer of silver overall when you account for all sources. They buy more silver than they produce domestically, so they're not sitting on some massive strategic stockpile they're now deciding to hoard. They're actually dependent on imports from other countries to meet their own industrial needs. Yet they just restricted exports of the silver that does flow through their territory. Think about what this creates. Western industrial buyers, solar panel manufacturers, electronics companies, defense contractors, they've all structured their supply chains assuming Chinese silver remains available at predictable prices. Those 148 million ounces weren't optional supply. They were baked into production forecasts, inventory planning, and cost projections for 2026. Starting now, that supply either gets significantly reduced or comes with new friction costs as it flows through restricted channels. Companies that relied on spot market purchases to meet their silver needs will discover their usual suppliers can't deliver at quoted prices. The premium they'll pay won't show up in COMEX spot prices, but it'll show up in their cost of goods sold and eventually in the prices consumers pay for solar panels, electronics, and other silver-intensive products. The United States faces particular exposure here because our industrial demand for silver is non-negotiable in many applications. Defense electronics require silver because nothing else matches its conductivity and reliability in extreme conditions. Missile guidance systems use silver. Radar components use silver. Secure communication devices use silver. You can't substitute copper or aluminum when the performance specifications demand silver's unique properties. We added silver to our critical minerals list in November 2025 for exactly this reason. Our government recognized that dependence on foreign supply of strategically important materials creates vulnerabilities, but recognizing the problem and solving it are two different challenges. We don't have enough domestic silver production to meet our needs. Restarting or expanding mining operations takes years and requires sustained high prices to justify the investment. So we're caught in a window where demand remains strong, Chinese supply is being restricted, and our domestic production can't fill the gap. That's the setup for a price spike that overshoots fundamental value before eventually stabilizing at higher equilibrium levels. Bank of America's analysts understood this dynamic when they built their price targets. Their $135 conservative forecast uses the gold to silver ratio of 32 to 1 that prevailed during 2011's precious metals rally. Back then, both metals surged as investors sought protection from monetary instability and sovereign debt concerns. The ratio of 32 to 1 wasn't arbitrary. It reflected markets pricing silver as both an industrial metal and a monetary alternative. Apply that same ratio today. Gold trades around $4,300. Divide by 32 and you get $134. That's BofA's baseline scenario, assuming we see conditions similar to 2011, elevated inflation concerns, geopolitical uncertainty, and investors diversifying away from purely financial assets. But their $309 target uses a different historical precedent. The 14 to 1 ratio from 1980. That year was extraordinary. The Hunt brothers attempted to corner the silver market while Iranian revolution disrupted global energy supplies and inflation reached double digits. Silver became the most sought-after commodity on Earth, briefly touching $50 when gold traded around $800. The 14 to 1 ratio represented extreme crisis conditions where silver was scarce. Industrial buyers were panicking and investors were hoarding physical metal. Here's what you need to understand about those historical ratios. They didn't exist in isolation. They occurred during specific moments when multiple forces converged: monetary instability, supply disruptions, geopolitical shocks, and industrial demand competing with investment demand. Does 2026 look like it's setting up those same conditions? We've got Venezuela making moves in South America that could escalate into broader regional conflict. China and Japan exchanging warnings over territorial disputes. Middle East tensions simmering without resolution. Trade relationships being restructured through tariffs and export restrictions. Inflation concerns persisting despite central banks' best efforts. An energy transition mandates accelerating globally, driving unprecedented demand for industrial metals, including silver. The catalysts for a 1980-style ratio compression are arguably more numerous now than they were then. We're not dealing with one isolated crisis. We're dealing with overlapping systemic pressures that create the kind of uncertainty that drives people toward hard assets. Let me give you a timeline based on how these situations typically unfold. Phase 1 is happening right now. Physical premiums are signaling the break. When American silver eagles sell for 15 to 20% above spot, when Asian markets show 50 to 80% premiums when dealers can't keep popular products in stock, that's the market screaming that paper prices don't reflect physical reality. We're in this phase as of early January 2026. Phase 2 likely intensifies by end of first quarter 2026. That means when the full impact of Chinese export restrictions hits Western markets. The silver that was in transit during December gets consumed. Dealer inventories get depleted. Industrial buyers who thought they could wait and see realize they can't. COMEX delivery stress becomes undeniable as short position holders discover that taking delivery at paper prices is increasingly difficult. This is when margin requirements go up again, trading gets more volatile, and financial media finally starts covering the story. Phase 3 becomes probable by mid-2026. Triple-digit silver. Not because of speculation, but because industrial buyers genuinely need physical metal and are willing to pay whatever it takes to secure supply. When defense contractors need silver for weapon systems, they don't negotiate based on COMEX spot prices. They pay the premium required to guarantee delivery. When solar panel manufacturers have contracts to fulfill, they source silver at real-world prices, regardless of what futures markets quote. This isn't a prediction. It's a probability based on measurable supply destruction and documented demand growth. Could something interrupt this timeline? Sure. China could reverse their export restrictions. New major silver deposits could be discovered and brought into production within months. Global economic recession could collapse industrial demand. Any of those scenarios would change the calculus. But here's what you should consider. China doesn't make strategic resource decisions casually and then reverse them quickly. Mining projects take years to develop, not months, and energy transition mandates are politically locked in across Europe, North America, and Asia. Governments aren't backing away from climate commitments that drive solar and EV adoption. The path of least resistance is toward higher prices, tighter physical markets, and eventually a repricing that brings paper futures in line with physical reality. So what does this mean for you? If you hold physical silver that you acquired before prices broke through $80, you're positioned to capture the revaluation that BofA's analysts are projecting. Those holding through $100 will see their position appreciate significantly if we reach the conservative $135 target. And anyone who maintains physical holdings through mid-2026 could witness the kind of price action that defines a generation of precious metals investors. This isn't about getting rich quick. It's about understanding that when major financial institutions publicly project $309 silver after years of dismissing precious metals, something fundamental changed in their risk assessment. When governments reclassify silver as a strategic resource, they're acknowledging dependence on foreign supply that creates national security concerns. When physical markets decouple from paper prices by 50 to 80%, you're watching price discovery shift from futures exchanges to actual transaction markets. The smartest money on earth didn't suddenly become bullish on silver because of charts or technical analysis. They became bullish because the mathematics of supply, demand, and geopolitical positioning created an asymmetric opportunity where risk-reward strongly favors holding physical metal through the adjustment period. Bank of America finally admitted what your family, your financially savvy friends, and the international buyers driving physical premiums already knew. Silver at current prices doesn't reflect the supply reality we're entering. Whether we hit 135, 309, or some number in between depends on how severe the supply crunch becomes and how aggressively industrial buyers compete for available material. But the direction is clear. The timeline is measurable, and the opportunity to position ahead of triple-digit silver is closing as physical markets price in what paper markets still haven't fully acknowledged. Welcome to the silver supply shock of 2026. The question isn't whether it's coming. The question is whether you'll recognize it before everyone else does. Thanks for sticking with me through all the numbers and geopolitics. If this helped you connect dots you weren't seeing before, hit that subscribe button and like this video so more people can position themselves ahead of what's coming. And hey, maybe send this to anyone who's been asking why your family keeps stacking silver while Wall Street calls us crazy. AG out.